When you enter the investing world, you hear terms like value investing or growth or momentum investing. You wonder, what do they even mean? Should I stay away from investing and leave it to the pros? In this video, we go on another journey to find out the meaning of these terms. Investment by default needs to have growth of the value we put in, but there are these three popular strategies to do right. So we'll understand what exactly these are. We'll also compare these three. It's a versus battle of growth, value, and momentum investing. Lastly, we'll help out with which one is the best strategy for maximizing growth and profit. As they say, money keeps the score. So hit the like button and let's deep dive into a versus battle of investment strategies. Chapter 1. What is growth investing? First things first, we are investing for growth, quite literally. So let's figure that one out. But growth investing is not just a word. It is still rooted in the fundamental analysis of the underlying business. To condense it in a sentence, growth investing is looking for the future prospects of the company. For growth investors, if the company is in good health and growing at a very fast rate and expected to continue to do so, then that is an ideal investment. Growth investing puts earnings growth and the power of profit margins as the keystones of its investment thesis. This strategy can be better understood by defining growth stocks, which growth investors are looking for. Growth stocks are mostly emerging companies with a shorter track record but a very high rate of growth. Buying prices in such companies do not matter, as the stock is probably a multi-bagger due to its high growth pace. Such companies are small in size but outpace the industry average by a high margin. Fundamental analysis of such stocks focuses on earnings potential by using metrics like historical earnings growth, net and gross profit margins, returns on equity or ROE, and overall financial health by looking at debt interest numbers. Thus, it is heavily biased towards earnings growth analysis. However, the share price performance is also a factor, as growth investors look at whether the stock price rise has matched the fundamental growth performance. This metric is also called the return ratio, that is, the return of the earnings to the investor in the form of dividends and price rise. Since growth stocks may have a shorter history, their investors look at the return ratio to know that the stock is on the radar of the broader market. Without the recognition of its high growth, the price may not see a rise for quite some time, which makes the investment risky. Thus, growth investing combines some level of technical analysis or the analysis of price movement with a greater base of fundamental analysis. Our next candidate, value investing, takes a different approach. Let's look at it. But before that, if you're liking this video so far, drop a like and press the subscribe button for more such content. Chapter 2. What is value investing? Value investing is a strategy quite well known. It is the apple of the eye of the Oracle of Omaha, Mr. Warren Buffett, the most renowned value investor there is. Similar to growth investing, value investing is also rooted in fundamental analysis of the underlying business. However, it has a slightly different thesis on what to do with that information while screening stocks. Value investors hunt for value. Value in a stock is an element of mispricing. They say that stock price is not always a function of business fundamentals and earnings performance. The guru of value investing and Mr. Buffett, Benjamin Graham, has called this phenomenon Mr. Market. Mr. Market is a comical personification of the stock market who is irrational and inefficient. The market often misprices stocks from intrinsic value, which is calculated from the business fundamentals like earnings and growth in assets. The greater the difference between stock price and its intrinsic price, the better. The gap provides two things. First, it reduces investment risk. The beaten down price may be rock bottom, which can jump to some higher level even if it doesn't reach the intrinsic value. Graham calls this the margin of safety. The second is long-term recognition of value. Graham has said that in the short term, market is a voting machine, but in the long term, it is a weighing machine, meaning the market tends to lose irrational behavior over a longer investment horizon. Thus, in value investing, a consistent hunt for undervalued stocks and waiting till they reach fair value or even somewhat overvalued status is key to investment success. Now let's move to the next strategy, which is much different from both growth and value investing. Chapter 3. What is momentum investing? Momentum investing takes a technical route to maximize the invested capital. For momentum investors, the market trend is their only friend. This style is much more opportunistic about market trends and therefore of favoring some stocks and disfavoring others. Momentum investing is basically go with the flow investing. Here, technical indicators of stock price are used to study the trend and the force of market momentum to decide whether the flow is upward or downward. Basic price indicators include DMA or day moving averages. 50, 100 and 200-day moving averages are average prices of the respective period. Breaking of the DMA significantly, either upward or downward, indicates the trend. For example, if a stock goes above its 200 DMA, then it has significant upward momentum to set a new high. Technical analysis of DMAs also provides the momentum bands that suggest probable entry and exit points for the stock. Other technical indicators for studying the trend are oscillators. This includes RSI or Relative Strength Index and MACD or Moving Average Convergence and Divergence. The oscillators are basically mathematical formulae that study price chart movement to provide a better analysis of trends. A combination of price, DMA, and oscillator chart can provide any hidden trend which can be utilized for profit. Momentum investing may also deploy cross-asset and macro-level analysis. This means studying the trend of interest rates and government bond yields, which can either pull out or push money from the bond market to the stock market. Inflows or outflows prediction can decide a macro trend and momentum. Thus, momentum investing is rooted in technical analysis to predict the price trend. So, which of the three is the best strategy in your opinion? Growth, value, or momentum? Go type your answer down in the comment section below. Chapter 4. Key differences. Now that we understand each term and its broad differences, let's pit these against each other to summarize finer contrast elements. First is the investment thesis. Growth investing gives supremacy to earnings power, historical performance, and future potential. Value investing prefers intrinsic value as a reference and finds undervalued stocks trading below that value. Momentum investing is not concerned with business fundamentals but with market trends. Here, the difference is, growth approach considers the price to be reflective of value or to invest only if it is. Value style, on the other hand, prefers a misrepresentation and capitalizes on it. Momentum, lastly, only wants a prediction of price based on analysis of its past chart. Whether there's growth or value is not a concern for the momentum approach. Next is the risk profile. Growth investing takes on some risk due to the shorter company history and narrow approach to analyzing earnings growth. Value goes for a much lower risk to get the best price for maximum value. Temporarily beaten down quality stocks are great for value investing, which means low risk. Lastly, the momentum style is the riskiest, as predicting trends with confidence is hard. Also, their analysis is much narrow. Only past prices may not account for macro news like a conflict between Russia and Ukraine. Third is investment style and horizon. Growth investors believe in going long, that is, remaining invested for as long as possible. Since their analysis is based on growth, going short or profiting from selling in negative growth is not employed, as that cannot be said with certainty. The value approach recognizes intrinsic value as its cornerstone. Thus, it can go long or short for any amount of time. Return to intrinsic value from over or undervalued status can take months or years. However, their overall outlook ideally is to go long and for a few years. The momentum approach is considered quite a speculator. Most momentum investors look at a quick buck, investing for a few days or weeks. However, it can have long-term analysis, although not preferred as much due to the increased risk. So these are the finer differences between each approach. Now we go into answering the most basic question that you care primarily about. Which one is best for me? Chapter 5. Which plan is the best? To say which is the best style of investing is to dictate which one is the best fruit in the world. That is, it all depends on personal preferences and risk profiles. Some of you may find growth investing suitable while others value. For young investors, growth or momentum investing is more suitable according to their risk profile, while older ones should move to value. Older investors should definitely stay away from the high risk of momentum. Also, there is no bar on mixing styles. It is not illegal to combine these styles and have separate value, growth, and momentum portfolios. In fact, Warren Buffett's style of investing is a combination of value and growth. His mantra is, "It is better to buy wonderful companies at a fair price than fair companies at a wonderful price," which gives away his leaning towards growth style and hunting for multi-baggers. So you can decide which is best for you based on your age and risk appetite, and even combine these strategies to create a hybrid style that suits you. Let's summarize our lessons from the video. Growth investing, as the name suggests, focuses on growth rooted in earnings growth. Value investing screens stock tickers based on an intrinsic value calculated by its business fundamentals. Lastly, momentum investing studies the trend of the market and profits on the prediction of such trends, whether up or down, going forward. Each style has its own advantages and limitations. Which style is the best is dependent on your needs and orientation to benefit the most from the risk you take. A combination of strategies can also tweak the risk-reward ratio. Always remember this Warren Buffett quote. Basically, all investment is value investment in the sense that you're always trying to get better prospects than you're paying for. So chase better prospects with whatever style you prefer. Don't forget to type your preferences from these 3 strategies down in the comment section below. This brings us to the end of the video. Press the like button if you haven't already and subscribe to the channel for more such content. We mentioned the goal of chasing multi-baggers. To learn how to do that, you can visit this video.